Good morning. This is Barry Knapp with Ironsides Macroeconomics. It's Monday morning, August 12th at 7:15 a.m. Mountain Time. Our note this week was titled Overly Restrictive Policy. This is the introductory version of our weekly audio and video summary of our marquee note. We'd urge you all to consider becoming a client, a full paid subscriber, and read those notes. They're 2,500 to 3,000 words, complete with our recommendations for sector and asset allocation. The title of the note, Overly Restrictive Policy, was a topic we discovered on a couple of media appearances last week, a CNBC appearance with Kelly Evans on the Exchange on Tuesday, and then with Oliver Rennick on the Schwab Network on Friday morning. We also released a tweet that's about as close to a viral tweet as we ever had. It got 100,000 views or so in fairly short order, describing how the Fed's policy mistake was not skipping in July. It was the very nature of the tightening process. They eased mostly through their balance sheet and they tightened mostly through rate policy that shifted the burden of weaker demand onto small banks and small businesses from large banks and large businesses and wealthy households who owned assets to people that lived paycheck to paycheck and needed to finance at floating rates. So that was part of the discussion at the beginning of the note. The real questions we were trying to address in this week's note was that magnitude of the correction we expected, because of course this had been our forecast that we were going to hit something of an iceberg in the labor market, and that was the equity market was not going to be able to look through that. That's of course what developed, not some random market unwind of Japanese carry trades. That's not even what happened to Japanese equities. They were up because it was a Gen AI play. The biggest names in the index are semi-cap equipment names. The real longer term thesis in being long Japan is better corporate governance and normalized monetary policy that improves banking sector profitability. But if that event over the last few weeks gets the Bank of Japan or spooks the Bank of Japan and they don't continue to tighten policy, then we'd become more negative on Japan and give up on it as a long, as it were. It was a small position for us. But there's no doubt that this is about weakening labor market. The worst that is going to get worse before it gets better. It's sometime before the Fed meeting. Fed officials do not sound prepared to get on a path to aggressively cut rates to 4%, the level that would painlessly disinvert the curve. And so we do not think the growth scare is over. We don't think the 10% or 9% or so peak to trough correction is quite enough. It'd be more like 12 to 13%. If we were to get a recession, then obviously the correction could be considerably deeper. The median decline in a recession-related correction is 24%. The average is 30%. We had 27% back in 2022, which discounted the earnings recession that followed. That, of course, is a possibility because, as we discussed in our note, we went through, and the chart that I have here for those of you that see the video version of this is that consumer discretionary, the leadingest of the leading indicators, those revisions are plunging. And that's not such good news going into big retailer earnings this week and into next, retail sales later this week. It does look to us like the weakening of the labor market is bleeding into consumption as well, based upon what's happening to analyst estimates after these companies report earnings. So we don't think we're out of the woods. We don't think this process has run its course. We also discuss a bit of an inflation preview in this week's note. And I'll give you the bottom line here as opposed to getting into the gory details. To get the gory details, you got to become a subscriber. But with a consensus number this week, inflation, all item CPI will be 2.9%. The median rate since 1947, when this series began, is 3.0. The standard deviation, though, the median standard deviation of the annual CPI is 0.58. That's the long-term median. Last month, it was 0.23. So the Fed has achieved price stability. They ought not to be pushing on their inflation mandate anymore. The 2% target was ill-conceived. They've got inflation volatility tamped down. They've got some measure of price stability here, the way we think about it, and pushing any further risks, pushing the economy over a cliff. We've triggered the SOM rule. All the dunking on the SOM rule is goofy. This isn't about labor, the unemployment rate going up because of immigration. That's not even really what happened, but that's not a real excuse. And we just used an anecdote of all our years on Wall Street. We always get hiring freezes before we get reductions in force, which is firing. So that's not the right way to think about the labor market. It's definitely weakening. And if there is going to be a recession, that's the one indicator to watch. And it's on the precipice. So the Fed needs to get started on that path to 4% in September with a 50 basis point cut. And that's where we think we're headed. And we think equities are probably headed lower before we get there. Buried Up Ironsides. Have a good week, everyone. Thank you.